Companies at the center of the meme stock mania that began 2 years ago have raised a collective $4.7 billion from the hype, according to calculations by the Financial Times, even as the windfall has done little to boost their performance. Eight of the most popular stocks in that regard have also gained a combined $7.5 billion in market capitalization since the retail trading frenzy at the start of 2021. On January 28th of that year, popular US broker Robinhood outraged customers by limiting their ability to buy those companies' shares, causing their prices to suddenly plunge. The small investors who helped send a series of mostly consumer names rocketing tenfold or more in mere weeks began with the aim of crushing hedge funds, betting on the company's collapse, as well as bolstering once beloved brands such as video games retailer GameStop. Another consequence of the share rally was to allow companies including cinema operator AMC and GameStop to raise new capital, highlighting how markets that are supposed to reflect corporate fundamentals can sometimes change them instead. Some bubbles do not really translate themselves into real world economy, but some bubbles do, according to Itay Goldstein, professor of finance at the University of Pennsylvania's Wharton School of Business, who now cites meme stocks in his lectures on the real world effects of trading frenzies. The alacrity with which some companies used inflated stock prices to improve their finances is the mechanism through which a trading frenzy can become self-fulfilling, he added. The lesson was to grab this opportunity and issue more equity. Since its shares soared almost 20-fold in January of 2021, AMC has raised $2.8 billion from sales of equity, new debt, and luring big new investors, according to the Financial Times calculations. Last month, that is December of 2022, it proposed to further rejig its capital structure. AMC has topped up the potential for recovery following the coronavirus pandemic, but rivals have struggled. GameStop has raised $1.8 billion in the past 2 years. By contrast, Bed Bath & Beyond, another retail investor darling, has warned of possible bankruptcy as of the 26th of January 2023 and disclosed receiving a notice of default from JP Morgan Chase. The home goods chain was far slower to tap shareholders, only raising new equity late in 2022 after it bought back $400 million of its shares in 2021 in a bid to show confidence in a turnaround plan. The big difference between the meme frenzy of AMC and the meme frenzy of Bed Bath is the underlying market timing and conditions that are quite different. According to James Gellert, chief executive of Rapid Ratings, a data analytics group that tracks financial health, when AMC and GameStop were at their height, and when AMC issued more equity, we were in a bull market with a tremendous amount of liquidity. Today we are in a high volatility environment in the closing hours of a credit cycle with reduced liquidity. AMC boss Adam Aron put it more bluntly this month when discussing the collapse of US cinema rival Regal, part of Cineworld. If you question why AMC keeps on raising so much cash in tough times, companies don't just die. Companies who don't just die, according to him. However, the gap between fundraising and performance suggests painful lessons may still lie ahead for meme stock investors. GameStop's fresh funds helped it transform a net debt of $690 million in 2020, more than twice its market capitalization at that time, into a net cash pile worth $468 million as of October of 2022, according to S&P Capital IQ data. Yet it has not produced operating profits since early 2019, and since its shot to meme stock fame, a 17% rise in sales has been matched by a similar increase in costs. suggesting that positive returns on its new funds are elusive. In an extended bull market period, companies can survive for a very long time as unprofitable entities, and as long as you can raise capital to burn, you're fine. But at some point, the music stops, according to Gillette. It was rational for companies caught up in the meme mania to seize the chance to raise capital at attractive rates, according to Harry Mameski, Columbia Business School finance professor. However, he added how much time they bought themselves depended on how much equity they managed to raise compared with the amount of debt already on their books. Alongside GameStop, AMC, Bed Bath, Robinhood's January 28, 2021 buying ban included BlackBerry, Nokia, Kos, Express, and Naked Brands. Naked Brand has since been taken over by Hong Kong-based electric vehicle maker Central Electric. Naked Brand's chair and chief executive, Australian Justin Davis Rice, was only second to AMC's Aaron in spotting the fundraising opportunity. After raising $50 million selling new shares in January 2021, Naked raised that to $183 million in total by July of that same year. So, meme stock business, they have all raised $4.7 billion since that frenzy began, and the bonanza for retail investors has not been accompanied by performance improvements. So, see what you make of all of these things. It's the anniversary of the meme stock frenzy, and thank you very much for watching this video.